Government versus the market. Who's really in control? It's this constant tug of war in finance, right? Two massive forces. And today, we're going to try and figure out who's actually pulling the strings. We all kind of think of the stock market as this perfect arena, right? The ultimate capitalist battlefield. Good companies win, bad companies lose. Simple. But is that the whole story? Is that what's really going on? Or is there something else? This invisible hand from Washington that just swoops in and props everything up? A safety net for the companies that are just too big to fail? It changes the whole game. And that's exactly what we're digging into. All right, so let's get into it. Is this a fair game or is it a safety net? Okay, so here's the fundamental conflict, right? On one hand, you have the textbook free market ideal. Economists call it creative destruction. Basically, if a company is weak, it should fail. That's good, it's healthy, makes room for the strong. But then there's reality. The fear that if one huge company goes down, it could be like a domino effect, a chain reaction, that systemic risk you hear about that just tanks the entire economy. And look, this isn't just some theory. It's literally the story of the last 100 years. I mean, think about it. The Great Depression in 29, that changed the government's role forever. Black Monday in 87, the Fed jumped in. The 2008 crisis, massive, massive bailouts. And then, of course, 2020 and the COVID crash, just unprecedented stimulus. You see the pattern here, right? Every crisis, the response gets bigger. And of course, there's the politics of it all. I mean, let's be real. No president wants to be the one in charge when the market crashes. A rising market looks great for their report card, right? So it doesn't matter what party they're from. They've got this huge incentive to keep the market up, even if that means stopping it from finding its natural, fair price. Okay, so the government wants to step in. But how? What do they actually do? Well, they've got a whole toolkit. Let's take a look. All right, this is super important because a lot of people get this mixed up. You've basically got two different players on the field. First, there's the federal government. Think Congress and the Treasury. Their tool is fiscal policy. That's stuff like government spending, stimulus checks and tax cuts. Then you've got the Federal Reserve, the Fed. They're the central bank. Their tool is monetary policy. That's interest rates and this other huge one we're going to talk about, quantitative easing. So what in the world is quantitative easing, or QE? Okay, stick with me here. The simplest way to think about it is that the Fed, well, it basically prints digital money. It creates it from nothing. Then it uses that new money to buy up tons of stuff, mostly government bonds from the big banks. What does that do? It's like pumping a fire hose of cash into the financial system. That pushes interest rates down and, in theory, encourages everyone to borrow and spend, boosting the economy. And just to give you a sense of the scale here, it is massive. Look at this number. After the 2008 crisis, the Fed's balance sheet went from about $900 billion to, wait for it, $4.5 trillion. That is an unbelievable amount of money pumped into the system. But you can't do that without consequences, right? This much intervention creates all kinds of distortions and a huge debate. So what are the side effects? Well, for one, it pumps up asset prices, stocks, housing, which is great if you already own assets, but it seriously widens the wealth gap. It also messes with the market's natural signals. You end up with zombie companies that should have failed but are just kept alive on cheap money. This also creates what's called moral hazard. It's this idea that if big players think they'll always get bailed out, why not take on crazy amounts of risk? And maybe most importantly, where does this leave small businesses? They don't get these bailouts. They're at a huge disadvantage. Which brings us to the big, thorny question. Should we just let it burn? Let the market correct itself, find its own true value, even if it means a massive, painful crash? Okay, let's stop talking in hypotheticals. What would a 30% drop actually look like? Let's say from the highs in September 2025. Well, the S&P 500 would crater to around 4,600. The NASDAQ would drop all the way to 14,000, and the Dow back down near 30,000. I mean, we're not talking about a little dip here. That's a brutal, brutal reset. Years of gains, trillions of dollars of wealth, just gone. So that's the dilemma. But what's happening right now in 2025? It looks like the whole playbook is changing, and honestly, in some pretty weird ways. Okay, so here's fact number one, and it's a bit of a shocker. Right now, as of September 2025, the Fed is not printing money. They're doing the exact opposite. It's called quantitative tightening, or QT. They're basically letting their massive pile of bonds shrink, which slowly sucks cash out of the system. And here's another curveball. In August 2025, the US government announced that it now owns a 10% stake in Intel, yeah, the chip maker. This isn't a bailout. This is the government directly buying a piece of a major private tech company. That is really unusual. And it's not just stocks. The game is changing for crypto too. For years, when the government seized Bitcoin, they just auctioned it off. But not anymore. A new policy in March 2025 created a strategic Bitcoin reserve. So now the Treasury is holding Bitcoin, almost like it holds gold. That is a massive shift in thinking. So after all that, what does it mean for us? For you? How do you even begin to navigate this new normal, where the line between the market and the government is getting blurrier by the day? Well, here's why this matters to you. The market doesn't just move on company profits anymore. It swings wildly based on what the Fed says or a new tax cut or a new tariff. That makes things incredibly unpredictable for investors. So what's the advice from analysts? They're recommending a balanced approach. Stay in the market so you don't miss out on gains, but maybe keep a little more cash on the sidelines than you used to, just to handle the inevitable shocks from all this policy chaos. And all of this leaves us with one final, really big question. In this era of constant intervention, what's really driving the market? Is it the stuff we've always been told matters, economic fundamentals, innovation, company profits? Or is it just government policy? Is it just what happens in Washington? That's the question we all have to grapple with now.